Now that it is firmly established that the earnings recovery is around the corner and better days are coming, how would you approach this market?
So, the overarching thing, Nikunj, and good morning to everybody, to your viewers as well. The overarching thing, and I heard a few of your comments leading into this program, is that we are in a structural bull market. Okay, so I will keep emphasizing that from time to time because that message should not get lost while we are trying to identify what the market may do in the short run or over the next few weeks. So it's a structural bull market, as you rightly point out, led by a new earnings cycle. And the reason for the new earnings cycle is primarily because we have seen a seminal shift in government policy. So this shift happened in September 19 with the corporate tax cuts. And the government is clearly pursuing a path of trying to boost profit share in GDP, by which they get more capacity, more investments, more jobs, more wages, and greater prosperity for the population. See, the previous path that was being pursued by successive administrations was to boost the share of wages in GDP. It did not really work because India has surplus labor. And what it caused was inflation pressure. And then growth slowed down. So we are out of that 13-year experiment, and now we are back into where we used to be in that period between 1999 and 2003. So this is the overarching theme. Now, within that, of course, we've had a very big market move. The market move is actually not that big if you look at it with a slightly longer time frame lens. So if you look at 3-year compounded annual returns, or you look at 5-year CAGR on the Nifty, it's actually underperforming gold. And it's not done anything compared to what it has done in past bull markets. So there's a lot more leg to this market before it's done and dusted. In the meanwhile, of course, what's happening underneath is two things. One that you pointed out, which is there's a clear move away from large caps into small caps. So that means that the Nifty struggles, but the small and mid cap indices do well. And then there is a clear shift within the Nifty away from defensives or the businesses that are less sensitive to accelerating growth to cyclicals, which is businesses that are more sensitive to accelerating growth. Now, if you look at the weight of the Nifty or the constituents weight, it is actually towards the defensive because those are the stocks that have done well over the past decade. Now, when they are giving up relative performance in favor of the stocks that have a lower weight in the index, naturally, the headline index performance will not match the pace of the past few months. So I think that pace will slow down as that rotation happens, as new leadership emerges. And then after that break, and you referred to it as maybe a consolidation or maybe even a near-term correction in the Nifty, I think you get another move up. But we are a long way from, I think, this bull market top. Within that, I think investors should, those who want to trade this market can look at it slightly differently.
Ridham, the points which you've alluded to are very important, that we are the beginning of a growth cycle, earning momentum is here, earning to GDP, those ratios, they need to catch up. But how does one figure out that while earnings will surprise us, the market is pricing in the template which you just mentioned?
No, that's a very good point, actually, Nikunj. So the challenge here is that everybody cites the PE ratio. Now, I would argue that earnings are very depressed versus potential. Okay, not only because of COVID, but because of 10 years of below par or sub-trend growth that India has had. So if earnings are depressed, then price to earnings may appear to be elevated more than actually it is. If you normalize earnings, then the market is not so rich on price to earnings. Normalized earnings for this economy may be almost double of what it is currently. So the P ratio may almost be half of what it is currently. So that's the first point to note. The second is, therefore, you default to metrics that are less sensitive to earnings, like price to book. But even book values are probably depressed because earnings were depressed. So there has been less accumulation of earnings over the past few years. Nevertheless, it at least somewhat offsets the challenge of using PE as a valuation ratio. The other metric you could use is market cap to GDP. Now, again, the problem there is that GDP went through a big shock in the trailing 12 months. So it is also depressed. And again, GDP growth of the last 10 years may have been subpar. So again, GDP is also depressed. So, the problem here for lay observers is that the market is a forward-looking animal. It's looking at what will happen in 1, 2, or 3 years from now. And if things are going to be a whole lot better, then, the valuations are not going to be as challenging as they look today on a headline basis. And you will realize this in hindsight. It reminds me of the 04-07 cycle, Nikunj. In 2003, the Sensex started at somewhere around 2,800, and by the following January, it was already at 45, 4,600. It had almost doubled in 12 months, and it continued to look more and more expensive. But we got such a ferocious earnings cycle, nifty earnings compounded at over 25% per year for 4 years on the trot, that every time you looked at the market valuations, they looked rich. And it took really bubble level valuations by the start of 2008 to break the markets back. So I don't think we are there right now in terms of valuations. I wouldn't characterize these as bubble level valuations, simply because the earnings are very depressed.
Okay. I want to bring this point out, Ridham, again for our viewers here, that the general belief in the market was or is that interest rates will remain low, and a uptick in bond yields is something which could lead to A, liquidity will not come, B, repricing of equities, because if interest rates go higher, the discounting cash flow changes. But in your report, which is dated 23rd of Feb, you've done great work on how it's the other way around. Let's discuss that.
So, Nikunj, see, what matters with rates is how growth is faring relative to rates. And here we are referring to long-term interest rates, not to short-term rates. I'll come to that in a moment. So when long-term interest rates are rising, we have to make a judgment whether growth will rise faster or not. I dare say right now we are in a cycle where growth is likely to rise faster than long-term interest rates. And so far as that is the case, equities actually do well. So again, I'll cite the 04-07 example very briefly between 2009, 2010, or you go back to the mid-90s. Each time there was a uptick in long-term interest rates, it largely reflected the bond market's optimism on future growth. And growth was rising faster than rates, and therefore the markets were doing fine. At any point in time when growth slows down relative to interest rates, that's bad for equities for all the reasons that you cited. So that is, I think, the template to understanding interest rates. Now, also bear in mind that there is a global scenario here, and we have to keep that in mind. India is amongst the 7 or 8 largest stock markets in the world. It's not a mid-cap stock in the world global stock market scene. It will be sensitive to what happens in other large markets. And here, I think what happens in the US is very important. We must not forget that in response to COVID, global central banks from the US all the way to Japan have responded in an unprecedented fashion. The amount of liquidity that has been put out there is almost 4 times more than that was put in response to the global financial crisis. Now, I would characterize the global financial crisis as a crisis which triggered a recession which came from economic excesses, and therefore required a very big policy response. The recession that we got last year was triggered by an external agent, which we didn't understand. We probably still don't understand it well enough. And therefore, in response, we got a stimulus that is, I don't think that has ever happened in the history of the world. I mean, even during World War II, we didn't see such synchronous response from central banks and governments. So keep that as a backdrop. Whenever that view changes, it will produce a volatile moment in the market that will be quite vicious for stocks, which is that at any point in time, if the US stock markets, as an example, start believing that the Fed has fallen behind the curve, that inflation is now ahead of the Fed, it will produce a very big, sharp correction in stocks. That could be a very, that could be of the magnitude of 25% fall in stocks very quickly. We saw shades of that in February, but we have not got to that point where the market has started believing that the Fed is behind the curve. And the final point on long-term interest rates is that this dovetails into the underlying structure change in the market, which is companies that can grow their earnings faster than the rise in interest rates are the stocks of those companies are the ones that are going to do well. So we typically group them into a bunch called cyclicals. So that is why cyclicals do well, because cyclicals can grow earnings faster than the rise in interest rates when the economic cycle turns. So it's this is all very fundamental. There is nothing. There's no there's no magic in this. This happens all the time. So that underlying structure change is happening within the Nifty. Likewise, smaller firms tend to have greater leverage to the economy, and therefore can grow their earnings faster than larger firms when the cycle is turning up. And therefore, stocks of those smaller firms do well. So that explains why SMID is outperforming large cap and why cyclicals are outperforming defensives.
Okay. Ridham, it's not patriotism, but if I look at what the positioning of India is, when I speak to corporates, they are using the term highest ever margins, highest ever sales, highest ever demand. If I speak to strategists and experts like you, you're making a bullish picture for India for next 2 to 3 years. If I look at HNI investors like Rakesh Jhunjhunwala and Radhakishan Damani, they have got the skin in the game, all of them are fully invested. Are you getting a sense that next 3, 4, 5 years, they actually belong to India at a global level? What happened in US in last decade, what happened in China in early 20s, in early 2000, this is the time, this is our moment, let's go and seize it.
See, Nikunj, there is a global trend that we have detected, which I think is now apparent to most people, which is, I think, swinging in India's favor. And it's what we call as the multipolar world. For almost 3 decades, the world was in a bipolar situation where almost all production was concentrating in China and almost all consumption was in the US. And everybody else was a side player in this. From a bipolar world, for many reasons, both political as well as economic, we're moving into a multipolar world. So the consumption centers are dispersing and the production center is also dispersing. Now, India is sitting at that very sweet spot where it offers an incoming investor, and I don't mean a stock market investor here, an incoming business, the opportunity to access a large market and the potential to set up production here. Now, the government has very smartly detected this and has therefore launched the production-linked incentive schemes and has forcefully cut corporate tax rates. See, this is, I think, the reason why corporations around the world will be looking at India very closely. And again, I hope I don't go wrong on this, but I think India will get massive FDI in the next 4 or 5 years to reflect this shift away from China as a production center and the shift into India as both a viable production center as well as a viable consumption market. India is still very small. It's only $2,000 per capita income. It's 1/6 the size of China in per capita income. It's 1/15 the size of the US. But I guess in the next 10 years, it will become a whole lot larger. And that's the opportunity that businesses want to lever. So I feel India will be a very pertinent point of discussion in boardrooms, and there will be serious thought about shifting production. Now, this has not happened so clearly in the past because India has not been an easy place to do business. And I think some of that pain of doing business is being offset by these hard monetary incentives that the government has thrown at businesses. And therefore, I think there will be a serious look. So if you put that into context, then what you say may be right. I mean, we may be at a very big inflection point in terms of wealth creation. We may not still become, we are not likely to become larger than China or the US anytime soon. That's going to take several years, if not decades. But we will become more important. And that, I think, is already happening.
Sure. Ridham, I was just going through your last note, and just to leaf out of that, this is a stock picker's market with ample alpha opportunity. So help our viewers understand what are the tactical, investment thesis that you're going by. Where is it that you think that alpha opportunity resides, and where is it that one can make money even if you were to buy afresh at these levels?
See, structurally, I think you want to buy discretionary consumption and industries. Discretionary consumption because India is now past the point where the share of basic necessities like food, shelter, and clothing will decline in the total consumption pool. And therefore, there will be a lot more disposable income available to do non-discretionary spends. Discretionary spends. So there will be, I think, faster than economic growth in the discretionary consumption sector. This includes a whole lot of sectors in India, from autos to paints to housing effects to education to travel to leisure. A lot of things are covered in what is discretionary in India. A large portion of the population doesn't have access to these consumption opportunities because they just don't have the disposable income. And that has changed over the past few years. It was triggered by the direct benefits transfer, so real cash going into the accounts of poor people. And now, because the economy is turning around, there will be real income growth there. So that is one. The second is industrials. Because of the point that I just mentioned earlier about India becoming a more attractive manufacturing destination, I think industrials may be actually poised to do quite well. In fact, we have already written about this a few months ago, that the share of manufacturing after declining for almost 25 years is likely to rise in GDP. And that could be an interesting thing for industrials. And I think from a cyclical perspective, you cannot avoid the financials. And we like the large cap financials as well as the mid cap financials. I think the mid caps may outperform the large caps, keeping in mind the overall theme that smaller firms do better than large firms. But the whole financial sector has to do well if the economy is turning up. So these are the three places where I tend to advise investors to park their money. And then you'll be underweight global-facing sectors because they will likely underperform in terms of growth relative to domestic cyclicals.
Sure. In the near term, though, Ridham, don't you think the discretionary spend thesis gets challenged because of high crude prices as well as high commodity costs as well? You know, when you're paying so much more for your commute or the fuel in your car, you're bound to cut corners when it comes to discretionary spend.
Yeah, so terms of trade does get a challenge. But remember, it only becomes a challenge, again, like interest rates, when oil is outperforming copper, with both being signals of what's happening to global growth, oil having an additional signal from its supply dynamics. So when oil is outperforming copper, it means the supply factors are overarching for oil relative to demand factors. And when that is happening, India's growth and India's macro stability tends to falter. Otherwise, it doesn't. Otherwise, rising oil price is just a signal that growth is in great shape. And so incomes rise faster than the costs. So don't look at costs in an isolated fashion. Inflation is clearly a risk factor for the market, as I highlighted earlier. But we're still not gotten there where inflation has become a problem. It may become one, and it could happen quicker than what we are thinking right now. So we have to keep a very close eye on it, but not for now. For now, income is likely to rise faster than input costs, and therefore, there will still be increasing disposable incomes.
Okay. Ridham, since you've also talked about the broader markets and the potential there, even within discretionary, there's such a wide, wide scope. Are there any particular, segments here, even without mentioning names, but where you feel that opportunity could be? And also when it comes to some of the leaders, I mean, there have been a lot of questions to do with, when you mentioned travel, leisure. We're getting a lot of mixed reports. On one hand, everyone's watching to see whether or not people will return to theatres with the next big release slated soon. On the other hand, we've had certain travel companies come on air and talk about how things have been actually pretty steady for them over the last 3-4 months. So slightly mixed, views that have been coming in.
See, I'm not the expert on all this, but I do think that there will be fatigue that has built up because of the lockdown and because of the restrictions on people's movement, which has lasted quite a long time, almost a year now. So there will be a lot of eagerness to move out and go to other places. Human beings, by their very nature, are creatures that want to move around, right? So we don't like to get stuck to a certain place. So that will happen, I think. Likewise, you mentioned theaters, but just overall entertainment has been too much of screen time, especially for the middle and upper middle classes. And they will want to move away from screen time and get other forms of entertainment. So I think in the next 12 months, the consumption in these categories may surprise us on the upside, just because of inherent human behavior. Longer term, and what I was actually referring to was the longer term trend, that remains intact. Because more and more people will move up from the bottom of the pyramid and they go one level higher, then they look to spend on things that they have not historically spent on. And this includes stuff like education, home effects, travel, leisure, media, a whole lot of things. Within that, I think to answer your question, I think auto parts look quite interesting. They have gone through a pretty big, I would say, down cycle for the past several years. And as auto demand normalizes, I think auto parts will do very well. So that's one place that investors can look at. Of course, there are some places over there where valuations have become very rich. So be careful of those. And then also be careful of the electric disruption. So avoid auto parts where electric can disrupt. I think electric will come much faster than what we think right now. So we should be wary of those places where electric can be a disruptor.
Interesting. Ridham, I completely see the picture that you've described and the rationale behind it. In the near term, though, and I also want to ask you, you kind of alluded to the volatility on the global front. From what you're saying, of course, in the long term, yes, but even in the nearer term, you're confident of the domestic story remaining intact and not being jostled so by the impact we may possibly see on flows, given what's happening globally?
One can never be 100% sure of anything when one's talking about the future. In fact, one should never be more than 50% sure. So I'm never more than 50% sure. There are two risk factors that we should keep in mind. One is the likelihood of inflation coming back globally. And it's a very pertinent risk factor, so keep that in mind. The second is any slowdown in policy impetus at home, because a lot of the benefits that we are likely to see over the next several quarters is due to the change in government policy. So keep an eye on that. That could change, and that could then cause some of the growth outlook to wane. If it doesn't change, and so far I have not detected any change, which is why I think the market celebrated the budget, because the budget just re-emphasized this policy shift that we have been seeing for the past several months. Actually, COVID was an interruption. Had COVID not happened, India's growth may have already gone back to above trend and may have been at a multi-year peak. So COVID has kind of deferred that by 8 or 9 months. Because this policy impetus change did not come during COVID. It came before that. It came in September 19. And through COVID, the government has had enormous courage to continue that policy shift. So it has not succumbed to any shift in policy so far. And this policy shift has experienced a lot of resistance from a lot of quarters. Look at the farm laws, for example. So it's not going to be easy. And therefore, we keep a watch on that.
Ridham, EV is a buzzword today, but I distinctly remember we spoke about it about 2 years ago on the sidelines of one of your Morgan Stanley conferences, or the Morgan Stanley conferences. It is not one of those, it is the Morgan Stanley conference. How does one really invest and participate in this mega trend in making, which is EVs will be a force to reckon with?
So unfortunately, I don't think the investable opportunities have still come in the listed space. A lot of them remain in the unlisted space. But one way of looking at it is to look at auto part companies that are not disrupted by electric, right? So those that do not get affected, whether we have ICE or electric. The other is to look at companies that are migrating to an electric platform, because some companies are doing that faster than others. So those are the two ways of looking at it. And, Nikunj, it's, It's quite heartening that you remember that conversation. I think it was actually 3 years ago, but there are a lot of other disruptions that are happening. There's disruption happening in the financial space. There's blockchain. There's fintech. There's ride share happening. So along with electric, autos are also facing the challenge of ride share. No doubt, ride share has taken a backseat because of COVID-19, but I think it'll come back. These are structural changes that are happening in global economies and in India as well. And the pace of change is no different from other places. So India is experiencing that change as quickly as other places on the planet because of porous borders. So we have to keep an watch on all these disruptions that are taking place. Disruptions are not unique. They happen all the time. But they leave a mark on certain sectors more than others. And if you are invested in those sectors that are getting disrupted, then obviously you may end up losing money. So keep a watch on that.
Well, I try to remember, Ridham, whatever you say, because sometimes those things are so valuable that it really benefits me and our viewers. I also remember that you were not bullish on tech. And your view was, look, I'm not very gung-ho about what tech companies are doing and the valuations are not looking that great. Are you surprised somewhere with the ability of tech companies to generate demand?
Yeah, it's been totally wrong. The call has gone wrong. I think, Indian software companies have responded remarkably well. I could have had a better call on that. Now I think the cycle is a little bit against them. So it's a relative thing. On an absolute basis, they will still be doing okay. But on a relative basis, I think domestic cyclically facing businesses may actually end up reporting much better growth and may offer better valuations. But in terms of the structural undertone in technology, I think there's been a remarkable shift that Indian companies have engineered over the past few years, almost without any exceptions. So I think hats off to them. They've done a great job.
Final question, Ridham, and something which is not a near-term question, but more like a big trend. You refer to fintech. Now, there are two types of changes which are happening in the financial world. First, financial companies are adopting tech, and there are tech companies which are trying to become fintech. So you've got tech companies which are becoming fintech, and you've got financial companies which are becoming tech. How do you see disruption moving out, and who will be the eventual winners? The companies which are adopting towards technology and are becoming tech, or tech companies which are trying to become into finance?
See, Nikunj, the challenge of making this call is that financials is a heavily regulated sector. Not anybody and everybody can set up a financials business. You come under the supervision of the RBI straight away. So there are barriers to entry because of regulations. Outside those barriers, there are opportunities for disruption. And I think there's an overarching technology of blockchain. There's a very important legislation which is sitting in the House on blockchain. And I'm keenly watching that. It could define a very important moment in India's future, how government policy around blockchain is framed. Blockchain is not a technology which we will be able to avoid. What it does ultimately, if it goes its natural course, is removes the requirement of third-party trust, which is what a bank serves in the system right now. So if blockchain is very successful, it actually completely alters the way the financial system, and this is not just the banks, but even stock exchanges, the currency markets, the lenders, the credit card companies, everybody's business will get altered. So I don't know whether we'll reach that extreme point, and I don't know how we get there. But along the way, I think banks, not just banks, but in fact, every entity in the financial services sector needs to adopt technology and be ahead of the curve. And those who do that, I think, will obviously fare better than those who don't. And it's still early days, so very hard to predict the winners and the losers. Just on the side note, Nikunj, the work that is happening on the fintech side, which is the non-financials who are doing technology, is amazing in India. And I'm just watching some really good startups that are sprouting, especially in Bangalore, which are introducing technologies which are far ahead of the world. So keep a watch on this space. There could be, unannounced disruption that may come and hurt some players in the financial services sector along the way.
All right, Ridham, thank you so much for joining us this morning. Always a pleasure, and good to get a chance to speak with you in detail about your views going forward.
Thank you for hosting me. Have a great day.